The bank's like, hey, you're paying off the loan first, then you're giving me then you could take whatever the profits are. A lot of people have done premium financing to supplement their retirement needs because, again, a lot of life insurance policies have a cash value portion that grows depending on the market, whether that's a mutual fund or a S&P or a stock-based index like the S&P 500. What'll happen is that account will grow average 5 to 8 to 10% a year, depending on the company, depending on the growth strategy. And their original plan was to make money off of the money. You're borrowing money at 3% for a long time. The S&P 500's average 6 to 7%. And inside of a life insurance policy, the growth is tax-free and the distribution is tax-free if you structure it correctly. So you're making 3 or 4% on arbitrage on that money that you just took out. Now, using that and then there's a bunch of other things that inside the life insurance policy that make it ideal for retirement planning. However, most of these policies, most of the time, you're relying on that arbitrage to be there. A lot of people have used this to supplement their retirement planning, not for the death benefit. The death benefit was an added plus. The biggest issue that we've seen, and this is where a lot of we were talking about the rates going up and so on and so forth. When someone does premium financing in a traditional sense, meaning they go ahead and they use it for a death benefit need to leave money over to their family, right? For estate preservation or wealth creation or so on and so forth. Those are usually fine because they're paying, most of the time, those guys are paying the interest out of pocket every year. So let's say on a $100,000 premium a year, the interest is $8,000. But you're paying $8,000 a year, you're getting a huge death benefit. Triple of what, if you take that $8,000 a year, you might have gotten an $800,000 death benefit. But with with premium financing, you're getting a $30 million death benefit, or exaggerating a little bit, but you're getting a $8 million death benefit, for example, right? Obviously, age and other factors apply. So premium financing was ideal in that case, and you're just paying that $8,000 a month out of pocket. However, when people use this to structure as a retirement plan, what most people didn't realize, and what I can say a lot of people who are trained in premium financing may or may not have mentioned, is that their expense charges in the policy, and there's a cost of insurance. The policy has to perform with a 2% or 3% arbitrage every year, meaning it needs to outperform whatever the loan rate is by 3% for the policy to work at a retirement level, for actually not even the policy to work, just for the policy to stay level, right? So the policy doesn't need additional funds or additional collateral. Now, for it to also perform on a retirement level where you're able to take distributions from the policy, you're not going to be able to take distributions for retirement, a supplemental retirement income, unless the bank is paid back. Because remember, the policy is a collateral, right? Just like, if we had a piece of property, we sold our house, right? The bank's like, hey, you're paying off the loan first, then you're giving me then you could take whatever the profits are. It's the same exact thing. The policy serves as a collateral. So anyone who put money into the policy, if it wasn't performing well, they're negative. Now, in the last 2-3 years, we've seen interest rates, we've gone to a high interest rate environment. The Fed's increasing it. I think at the time of recording it, they're saying they might increase it another 0.75, if I remember correctly, or another quarter point. A little bit behind on the numbers of where the interest rates are going. But regardless, the interest rates are a lot higher. The market's been forming, but it's been volatile. And depending on when your statement is and when your loan is due, you might be upside down, right? So what we're seeing in a lot of cases is, say someone got a 2% return on their cash value in their life insurance policy, but their loan rate went from 3% to 8%. So now they're -6, right? So, and unfortunately, majority of the premium financing cases that I've seen in the last 3-4 years that we've seen other people do are, these plans are structured for more a supplemental retirement income. So they need the positive arbitrage to hedge out, right? Now, if they're in one of those cases, are there things that they can do? Yeah, there's a little bit of restructuring. There's deferring the tax. There's having the plan run a little bit longer, maybe an extra 5 years, and so on and so forth. But using premium financing outside of what it was traditionally for, it doesn't work in a high interest environment unless you're putting a lot more money into it than what you would have in a low interest rate.